Students. This brief video is related with the very important topic of forward interest rate. First of all, we will be discussing about how to calculate forward interest rate. Now, this is very confusing. Students often perceive it that this is just like we have currency forward rate. So if I ask you how to calculate the currency forward rate, formula is very simple. You are going to use IRPT, interest rate parity theory. That is, currency forward rate equals spot rate into 1 plus interest rate divided by 1 plus interest rate of base currency. This is foreign currency, let's say, if you are using the indirect quotation. But my topic is not currency forward. My topic is how to calculate interest forward rate, because it may be problem for very often large number of students. They know how to deal with FRAs, forward rate agreements for interest rate hedging. But might be possible in a question they'll not be given with the forward rate, and first examiner will ask you to calculate the interest forward rate, then do the hedging. Now understand the issue? So for that purpose, remember how you will calculate it. First of all, always remember the formula for the interest forward rate is one plus spot yield or individual yield of year 2 raised to the power 2 divided by 1 plus spot yield or individual yield of year 1 minus 1. This would be the forward rate of year 2. And the forward rate of year 1 would be individual yield curve of year 1 or current annual spot yield of year 1. Now, these are the topics you have already studied in your WAC topic, but let's have a quick review of it. First of all, always remember that it means that first step will be how may be possible you will not be given the spot yield of company. If you are given with the spot yield of the company, then just put the spot yield values in the formula and you will have the forward rates. But I am assuming that you are not given with the spot yield of the company. So always remember that you are going to find out the spot yield of company's bond on the basis of spot yield on government bond. Okay, and the formula you will use is the CAPM formula. Spot yield equals RF plus credit spread. If you are calculating the spot yield of year one, you will use the risk-free rate of return of year one of government bond. This is often called spot yield on government bonds. Okay. So whenever you see that you are given with the spot yield on government bonds, okay. So I am just first step. You have to check out the spot yield on government bonds. Then step number two, use the CAPM equation. You will going to calculate spot yield of company by using spot yield on government bond plus the company's own credit spread of year one. Spot yield is also called individual yield curve. And the third step is you are going to calculate forward rates. Okay, so now I'll explain it in detail. You know that each year's, let's say for example, we have 5 years bond and I want to calculate its cost of debt or yield. I'll be just using RF plus credit spread. So I'll be using RF. Let's say RF is 4%. 4% plus 5 years credit spread. This would be the cost of debt or the individual yield of the, so not individual yield, the total yield of the bond over 5 years per annum. Let's say we have 10 years bond. Again, I would be calculating, I would be using RF 4% plus credit spread of 10 years. So I am using the RF value same, whether I want to calculate the cost of debt of or yield of 5 years bond or 10 years bond. So here it is a concept that government has issued 1 year bonds, 2 year bonds, 3 year bonds, and each year yield is called spot yield of the 1 year bond. Okay, and this is also called, we can say, RF of year one. So if, let's say for example, we want to calculate the yield of 1 year bond, we will be using the RF of year one. Now you got the point. Now let's solve the question, then you will better understand it. Let's say you are given the spot yield for the government bonds. Now this means that you have to calculate the spot yield for the company's bond. Spot yield means RF year wise. Okay, year wise RF 1, 2, 3. So RF of year 1 is 3.5%, RF of year 2 is 3.65%, RF of year 3 is 3.8%. Okay, so this is called spot yield for the government bond for the 3 years. Now let's say you are given with the credit spread of your business, and this is provided by, let's say, S&P, Standard and Poor, and this is in terms of BPS. We have three ratings: triple A, double A, and A. We have 1 year bond, 2 year bonds, and 3 year bonds. So credit spread for triple A for 1 year bond is 14 BPS, 29, 46, 25, 41, 60, 38. I am just giving the example, okay? And your company is Stone Co, which is A rated, okay? So what is requirement? We have to find out the spot yield of the Stone Co, or we have to find out the individual yield of each year of Stone Co. How we will find out? Spot yield of year 1, RF of year 1 plus credit spread. What is the RF1? 1 year RF. And what is 1 year RF? RF of first year is 1 year bond is 3.5%. Stone Co credit rating is A. 1 year A, it is 46 BPS. So add 0.46%. So spot yield of Stone Co's year 1 bond or 1 year bond is 3.96. This means that if government bond of 1 year is yielding 3.5%, the 1 year bond of Stone Co will be yielding 3.96%. Now you got the point. Similarly, I will find out the spot yield of year 2, RF2 plus the credit spread of 2 years bond. What was the RF? RF of 2 was 3.65% plus Stone Co rating was A, and the credit spread of 2 year bond is 60. So now what is the meaning of this one? That government 2 year bond yielding 3.65%, while Stone Co's 2 year bond yielding 4.25%. Spot yield 3, what was the RF3? It was 3.8 plus 0.76. This is 4.56%. Means government 3 year bond is yielding 3.8%, while Stone Coast 3 year bond is yielding 4.56%. This is definitely yield on the corporate sector is more than the government bond, because you know that government bonds are the risk-free bonds, so their return on them would be the minimum. So now you have calculated the spot yields. Now using these formula to calculate forward rate of interest. First of all, always remember that forward rate of year 1 would be the same as the spot yield of year 1. What we have calculated, it was 4 point, no, 3.96%. Forward rate of year 2, 1 plus spot yield of year 2 raised to the power 2 divided by 1 plus spot yield of year 1. In numerator, you will put the spot yield of the year for which you have to calculate the forward rate, take it square, minus 1. So year 2 spot yield is 1 plus 0.0425 raised to the power 2 divided by 1 plus year 1 spot yield, this 1.0396 minus 1. So this would be the forward rate of year 2. Let's say it is 4.2%. Okay. Actually, the formula is like 1 plus spot yield into 1 plus forward rate equals 1 plus spot yield of year 2. So this is like this one. So if I solve it, definitely it is forward rate 1 plus spot yield 2 raised to the power 2 divided by 1 plus spot yield 1 minus 1. Now let's move towards forward rate of year 3. In numerator, I will be using the spot yield of year 3 raised to the power 3. In numerator, I will be using the spot yield of year 2. If you are using the spot yield of 3 in numerator, put the spot yield of year 2 and 2 raised to the power 2. Similarly, if you they see the previous year 2 raised to the power 2 divided by year 1. So if I find out the forward rate of year 4, how I will find out? 1 plus spot yield of year 4 raised to the power 4 minus 1 plus spot yield of year 3 raised to the power 3 minus 1. So what is the spot yield of year 3? We have calculated it 4.56%. 1.0456 raised to the power 3 divided by what was the spot yield of year 2? 1. This is 4.25% square minus 1. So this is the forward rate of year 3. Okay. So now let's move towards the interest rate hedging using forward rate. Let's have a question on it. This is Avanco, and if you see, let's have the question. Second para, first paragraph is that you are a depositor because you will receive, then you will deposit 48 million. On 1st of February X1, and it will be invested on large projects on 1st of June X4. So for how many months you will going to invest it? February, March, April. Okay. Now let's see like this one. First of all, what is the date today? Assume it is 1st of November. X3. You are going to receipts on 1st of February X4. This means from today's in 1st November, December, January. In 3 months' time, you will be depositing the money for when you need it, deposit period. you will want to deposit it on until 1st of June. So this is February, March, April, May, 4 months. So few forward rate agreement will be quoted like 3-7. 3 means the starting period from now, 7 the ending period, and the difference would be the duration for which we need to deposit or we need to borrow. Okay, there. So let's see what are the rates. 3-7, 4.82% FRA is given. 4.82% FRA is given. So we have the option here. If you see, read the question, first paragraph, that it is difficult to predict whether the interest rate will increase or decrease in both cases. A third paragraph, the current interbank rate is 4.09 and expectation is it will increase or decrease by 0.9%. So let's solve the first situation. If interest rate increase by 0.9%, this will 4.09 plus 0.9 equals 4.99%. आवान को can deposit at. Always remember, you cannot deposit at the market rate. Definitely, bank will deduct the base rate, some basis points, because it will be the bank's profit. So what, depending on the credit rating, depending on the situation, Avan ko, if you read the third paragraph, less 20 basis points. So 4.99 minus 20. So this would be the actual interest rate at which Avanco will be receiving the interest. So now listen carefully. You have to calculate interest income, and interest income will always be on actual rate. What was the amount of the deposit? 48 million into, you will use the rate 4.79% for how much period? 4 months. You calculated 766,400. Now, one thing you should remember, you have to check out whether actual rate is greater than forward rate. If actual rate is greater than forward rate, and it is the case of deposit, in this case, company will going to pay to bank the difference, because in any case the maximum an entity can earn is forward rate. That's it. And vice versa, if actual rate is less than forward rate, this means that you are not receiving the agreed amount of forward rate with the bank. In this case, bank is going to compensate the company with the difference. So in our example, what was the actual rate? Actual rate was 4.99%. And what was the forward rate? Don't take the rate 4.79. This is not the actual rate. This is the rate available to the company. Always take the rate which is actually in the market. Forward rate is 4.82%. So here actual rate is more. So who is going to pay here? Company pays to bank. 48 million into the difference is 0.17% into 4 by 12. So this is 27,200. Net receipt is 739,200. Find out the effective rate. How much interest you are going to receive? 739,200 out of deposit of 48 million. For how much period? It is related with 4 months. So gross it up and multiply it with 12. This is 4.6% almost. Now let's solve the other situation, that if interest rate decreases by 0.9%, previously it was 4.09 minus 0.9, so this is 3.19%. So you are going to receive interest income. I told you interest income will be always on actual rate. So 48 million into 3.19% into 4 by 12. So this is 478 400. So now tell me here, actual rate is 3.19, while forward rate we had agreed is 4.82. So here, who going to compensate it? The bank will compensate to company. So means we have another receipts from bank. The difference 48 million into the difference between these two. This is wrong. This is not 3.19. This is the market rate. This is the market rate, and I have not basically included calculation was there. It is, you see, the 20 basis point less. So it is not 3.19. This is 2.99. Okay. Now take the difference. 4.82 minus 3.19% into 4 by 12. So this is 260,800. This makes total of 739,200. Now find out effective interest rate. Let's solve a question of borrower as well. Okay, now let's solve the question. Make an example. Let's say borrowing. Let's say today's date is 1st of July. X3. And you want to borrow on 1st of September X3 for 5 months. So how you will quote it? FRA, how it is will be quoted from today's date. How many months? July, August, 2. And You have been given the duration. So 2 plus 5, it will be 7. When the borrowing will end? 7 months. 2 dash 7. Let's say it is 4.5%. Borrowing amount is 20 million. And company can borrow at base rate or LIBOR plus 0.3%, because you cannot borrow at the official rate. Bank will add some BPS in it according to your rating. Assume that bank rate after 7 months is going to be let's say 4.9%. Now let's find out. This is the case of deposit. You have to pay interest. And I told you payments or receipts are always on actual rate. So 20 million into the official rate would be 4.979%, but bank will add 0.3% in it. It would be 5.2% into, for how months, how many months you wanted? 5 by 12. Now, this is the case of borrowing. If actual rate is greater than forward rate, you are paying more. So who is going to compensate? Bank will pay to company. But if actual rate is less than forward rate, then company is going to compensate the bank. In our case, actual rate is 4.9%, while forward rate is 4.5%. So we have paid more. So in this case, this would be the payment we will receive from bank. 20 million into difference, 4.9 minus 4.5 into 5 by 12. Okay, so this is how forward interest rate hedging works. Okay, I have basically taken you from step by step and then move towards the forward rate interest rate forward interest rate hedging using the forward rate agreements. Okay, so this is it. Okay, take care.